The phone is ringing in Omaha, and right now there's a financial wrecking ball cutting across the entire global system. It's not a virus. It's not a battlefield. It's not even a new rule from Washington. It's the United States dollar. Sure, it feels wonderful when you land in Europe and everything seems discounted because the dollar is so strong. Or when you buy electronics from overseas and the price feels cheaper than ever. But a dollar that skyrockets this fast and this aggressively doesn't just make vacations affordable, it breaks things. It breaks weaker economies. It distorts earnings for major American corporations. And if this continues, every major central bank from Tokyo to Frankfurt to London will be forced to respond whether they want to or not. Today I'm going to walk you step by step through the math behind this currency storm. The kind of story the evening news barely mentions. They focus on the daily ups and downs of the stock market. But if you want to understand where your money is actually heading over the coming years, you must pay attention to currency movements. It's the biggest market on the entire planet, and right now it is flashing dangerous signals. Let's start with something simple. Investing looks easy from the outside, but it never is. Understanding money works the same way. Everything connects to it. When the dollar is steady, international trade moves smoothly. But when the dollar explodes in strength, like it is today, its gravitational pull reshapes everything. Money rushes out of foreign markets and races back into the United States. This isn't magic. It's a combination of higher interest rates and global uncertainty doing exactly what they always do. The Federal Reserve kept rates elevated longer than expected to control inflation. When investors anywhere in the world can buy U.S. government bonds and earn 4, 5, even 6% with almost no risk, they start asking themselves a simple question. Why gamble on a business in Vietnam or a bond issued in Brazil when I can earn a guaranteed return in the most trusted currency on earth? So they dump foreign currencies, buy dollars, and we enter a self-feeding loop. The stronger the dollar becomes, the weaker everything else grows. Here's the danger. The world has buried itself in debt denominated in U.S. dollars. Developing nations, European companies, Asian governments, they all borrowed in dollars because the dollar is stable and widely trusted. But these borrowers earn their money in pesos, in yen, in euros, in rupees, while their debt must be repaid in dollars. Imagine a tiny lemonade stand. You charge $1 per cup. You borrow $50,000 to build it. If the dollar suddenly doubles in strength compared to the local currency, you must sell twice as many cups just to make the same interest payment. Keep that up long enough and the business collapses. Now scale that situation to entire countries. That is exactly what is unfolding right now. Look at Japan. The yen is plunging. The Bank of Japan is burning through reserves trying to stop the fall. But it's like standing in front of a tidal wave with a bucket. A falling yen sends cheap goods into the world, pushes deflation outward, and shakes the entire Asian trading structure. You might be thinking, I live in Texas, or Ohio, or Florida. I earn dollars. I spend dollars. Why should I worry about the yen or the euro collapsing? That's a very costly assumption. Close to 40% of the revenue earned by companies in the S&P 500 comes from outside the United States. Think about companies like Apple, Coca-Cola, American Express. These businesses are global. Sell a phone in India, they get paid in rupees. Sell a soda in Germany, they get paid in euros. When the dollar jumps sharply, those foreign earnings shrink the moment they are converted back into dollars for quarterly reports. A company can sell the same number of products, but the earnings per share still drop because the currency comparison changed. And this goes beyond earnings. A super strong dollar reveals a shortage of dollars in the global financial pipes. When dollars are scarce, something somewhere breaks. We saw this in 1997. We saw it in 2008. History repeats itself. Central banks across the world are trapped. If they cut interest rates to rescue their struggling economies, their currencies weaken further and inflation skyrockets. If they raise interest rates to protect their currencies, they crush local borrowers and real estate markets already under pressure. They are stuck, and the Federal Reserve is the one holding the lever. This surge in the dollar is also fueled by fear. The more turmoil we see, wars in Europe, conflict in the Middle East, declining growth in China, the more global money runs toward the one place it has trusted for nearly a century, the US dollar. Ironically, the worse global news becomes, the stronger the dollar grows. And the stronger the dollar grows, the worse the consequences for everyone else. So what should you do with your investments? First, don't try to predict currencies. I've never made a penny guessing what the yen or the Canadian dollar will be next week. That's a game for computers. Instead, look at your portfolio and ask two simple questions. How much foreign revenue or foreign debt is tied to this company? And does this business have strong brand loyalty and real pricing power? Companies with wide moats, the ones that can raise prices without losing customers, survive storms like this better than anyone else. And most importantly, keep cash, a lot of it. When a currency crisis triggers a liquidity squeeze, the best assets get sold at discount prices because people desperately need dollars. In 2008, we were able to lend to Goldman Sachs and General Electric on excellent terms because we had the cash when everyone else was scrambling. Cash is not just cash. It is the right to act when others can't. As for emerging markets, Wall Street spent years saying they were the only place for growth. Over the long term, that might still be true, but in a powerful dollar rally, they are hit first and hardest. Buying an emerging market ETF today is basically betting against the dollar. Oil is priced in dollars. A rising dollar makes oil feel more expensive everywhere else. Demand drops, and prices eventually fall. It looks like deflation from a distance, but it feels like recession for the countries dealing with it. Global debt is at the highest levels ever recorded. Trillions of dollars must be refinanced in the next 2 years at far higher interest rates, and all of it must be paid back in increasingly expensive dollars. We're heading straight into a wall. Corporate failures are rising. Commercial real estate is buckling. The strong dollar is simply the mechanism that reveals the cracks. Some people say a strong dollar means America is winning. In the short term, it keeps imports cheaper. But no nation can remain prosperous forever if the rest of the world contracts. This ends in one of two ways. Either the American consumer finally breaks under high rates and the Fed cuts sharply, weakening the dollar, or the rest of the world breaks first, creating a global financial panic that forces the Fed to inject liquidity again. Neither scenario is a green light to buy extremely overpriced tech stocks. Both point toward caution and protecting your capital. I've watched these cycles for more than 8 decades. The pendulum always swings back. In 2011, people said America was finished because the dollar was weak. Now they say the rest of the world is finished because the dollar is strong. The truth is never at the extremes. But while the pendulum is stretched this far, you don't want to stand in its path. At Berkshire, we keep enormous cash reserves. Some people laugh and say we're missing out. I sleep perfectly well. Your personal finances matter too. Do you have enough buffer if the economy slows? Do you have stable rate loans or variable ones? Are you holding assets that only function in a world of cheap money? Fix these vulnerabilities now while you still can. This crisis is silent for the moment, playing out in government offices and behind closed doors in foreign banks. Soon it won't be silent, and by that point, repositioning will be too late. Many people are paying premium prices as if everything is perfect, while the world around them becomes more unstable each month. The dollar is the wrecking ball, and it hasn't stopped swinging yet. I know this isn't the happy ending you may have wanted. Maybe you were hoping for the next stock that rises tenfold. That's not my job. My job is to help you avoid losing money. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. Stay careful out there, and we'll talk again very soon.